Good morning, good afternoon, everyone. My name is Maximilian Horster. I'm a partner in the South Pole Group, and I would like to welcome you warmly to our webinar, How Can Investors Capitalize on the Risks and Opportunities Associated with Climate Change Regulation? We thought we set up this webinar as kind of a stock taking since the Paris Agreement end of last year. We are now well, almost 10 months later. The Paris Agreement shows its ripple effects on different legislative initiatives, and we want to assess together with you how you can adapt your investment strategy to the current and the pending climate change regulations out there, and what are some suitable methods to do this. This comes from our point of view relatively timely with the G20 communique that was issued last week, where climate change or climate finance and green finance got one paragraph each, which is quite an achievement. And at the same time, some of us, also some of you that I see on the list here, are coming back from the PRI in person, the large summit of investors focusing on ESG issues. And those of you who were there in Singapore the last week, you saw climate change is still the #1 topic there. So this webinar, we try to keep it as interactive and informal as possible, and at the same time informative. This is challenging because we are quite a few participants here at your end, but please do at any point in time ask questions or comments, comment on what you see and hear. You can use the text box on your screen to send questions or comments, and we will pick them up on the go. We also have a Q&A session in the end. So today I have two experts with me from our team from South Pole. One is Guillaume Gauton. He is covering the French market for us. France, obviously, a geography where climate change transparency regulation is quite advanced, and the other colleague is Stephen Schofield, who runs our North American operations. Again, a place where, at least in pockets, climate change regulation is picking up quite a bit, and we will pick their brains later on their experiences and what they see in terms of developments. A quick word about us, about South Pole Group. We are climate change and environmental specialists. We do basically two things. We measure climate impact for around 1,000 clients, and we help these clients reduce their climate impact. And we do that with 150 specialists who work in 17 offices around the globe. We do assess our own impact. We are now 10 years old, and we are actually quite proud with regard to our achievements. You see some of them here on this slide. The one number that I would like to draw your attention to is the number at the bottom. We have by now screened over $2 trillion of assets under management for their climate impact. And I can tell you that the large amount of this sum we screened in the last 2 years. So this is a topic that is trending, and we are quite experienced in this space. So we work with a wide range of asset owners, asset managers, banks, insurance companies in Europe, in the US, in Australia, in Latin America, and now also increasingly in Asia. So let's look back at the Paris Agreement that took place in December last year. Great surprise to many of us who are following this after a series of failed or not so successful climate conferences. All of a sudden there was a consensus to combat climate change, and the approach that most companies out there and investors take is to look at climate change with a looking through it from a risk perspective. And I would like to offer a risk framework here that is relatively widely used out there now. So typically when we talk about climate change, and that applies both to companies as well, or corporates, assets in general, as well as investors, we distinguish between physical risks and transitional risks. So physical risks are detached from the Paris Agreement. Physical risks are basically risks that come with the change of global temperatures. You see extreme weather events, rising sea levels, droughts, floods. So if you are a company that is either operating in an area that is endangered by these events, or your client base is maybe in such geographies, if you want to assess the physical risks that come with climate change, you have to look into these issues. Now that there is a global consensus to try and combat climate change, we see a new dimension of risks emerging, which we call transitional risks. And these risks are basically linked to regulators stepping in, to societies changing. So if you are a company and your business model is to produce something, and the way you produce it is very carbon intense, there are certain chances that regulators will step in and no longer allow you to operate in the way you have been operating. So this would be typical transitional risk. And for investors, that of course means if you're invested in such a company, you might assess these type of risks that the companies that you are investing in are facing. And so when we look at the Paris Agreement, if we would have to sum it up, it's basically a commitment that global warming should stay well below 2 degrees Celsius. The number 1.5 degrees Celsius has been mentioned, so that is in comparison to pre-industrial levels. And what that means is basically that really every country in the world committed to move capital from high carbon industries to low carbon industries. And what does it mean concretely? It basically means that if these countries do what they promise to do, and that's really, as I said, all countries in the world, we will see huge ramping up of investments into renewable energy, smart grids, energy storage, kind of the alternative energy space. And we will see a fade out of fossil fuel subsidies. And at the same time, we have the commitment of countries to put a price on CO2 in one way or the other, be it taxes or cap and trade systems. And built into the agreement is, of course, the logic that every 5 years, countries have to come to the table and increase their ambition. And the way that countries express their ambition is in so-called NDCs, nationally determined contributions. So every country puts the best foot forward of what they're trying to achieve. And what that means for investors is that investments in low carbon assets are worth looking at because they might pay off. And in the regular investment mix, there are certain risks and opportunities that will be affected by the transition that is envisioned. So where are we with regards to the Paris Agreement? Well, 90 parties, so parties in this case are countries, have intended to use markets to implement or to contribute to the NDCs. That means we will see prices on carbon popping up around the globe. That can be taxes, that can be cap and trade systems, but for you as investors, that means if you invested in a company that is facing such a price, the P&L of the company will change it. It will likely impact the value of your investment. The Paris Agreement will come into place once 55% of the total global greenhouse gases have ratified it, or 55% of the global population. And that looked a little dire 2 weeks ago, and it has changed dramatically last weekend and this weekend. Last weekend, China ratified the Paris Agreement, and this weekend the US did, and they joined a group of smaller countries that had ratified it. So what that means is that we are now at almost 40%, so the 55% isn't that far out anymore, and that's when the Paris Agreement will come into place. Shifting gears now a little bit, so what does the Paris Agreement mean for those who signed it? So those who signed it are not companies, these are not investors. The signatories are, of course, countries. But these countries commit to make financial flows, that's one of the paragraphs there, consistent with a 2-degree economy. And so now, when we look around us, we see that countries are currently kind of in a stock-taking mode. and trying to figure out in how far climate change is impacting their economies and also their financial markets. So there is this stock taking that's happening. The gentleman you see here on the slide is Per Bolund. He is the Minister for Financial Markets in Sweden, and he at least currently takes the path of kind of a, well, I would call it de facto legislation. It's not a de jure legislation. He basically asks investors very loudly to report on their climate impact, and basically asks investors to self-regulate in this space. And so this is one approach that you can see as one of the more advanced governments in this space who have looked at that, but there are other examples. What you see on this slide here is we tried, and this is actually a heavily debated slide internally among my colleagues and myself, we tried to plot countries on a graph that shows level of understanding of the topic of climate change and level of standardization. And this, and you know, you can debate every single point on this slide. That's what we're doing. But the key takeaways of this slide is actually that governments are currently on the move. So they are now assessing in how far climate change impacts companies in their jurisdiction, and now increasingly investors. And I would like to just pick out 3 examples here. So the one in the middle that you see that reads IORP, that's not really a country, that is the Institutions for Occupational Retirement Provisions. So it's the legislation for pension plans in Europe that belong to corporates. And this just went through the last reading. These pension plans will in future be asked to report on their climate impact. A second example out there is Singapore. This is something that we took away from the PRN person. So Singapore, all of a sudden and almost out of nowhere, introduced at the Singapore Stock Exchange mandatory disclosure for companies on different issues, including climate change, and by that being, in terms of standardization, way ahead of many other countries. And the last example I would like to highlight is Switzerland. So there's just, maybe you hear it here first, the announcement that the climate change legislation is going through several readings. That also includes a focus on investors. And again, investors should, according to the text as it is now, report on their climate impact, and so be transparent, and also report on how far their investments might impact the climate. So this is something that that will go through the different instances in the next few months. So in a way, we are in a perfect storm, if you like. You have the international frameworks, the Paris Agreement, but of course also the Sustainable Development Goals. You have the G20. You have the countries, different countries reacting to that. And so there are strong signs that this transformation to a low-carbon economy is driven by an ever stronger political will. And if this happens, the world out there will look quite different. It means that quite a few economies will have to transform, different companies will have to transform in order to be compliant to such a 2-degree world. And also societies, the way we consume, the way we travel and so on, will probably change. And that puts investors into the situation that they ask themselves now, and we see that especially with large investors, in such a world, do my investments, today's investments, still make sense? Where are the next big investment opportunities that come with a transition? Every transition brings opportunities. And where are the large investment risks? So this is kind of the state of play, and I would now like to change over to my 2 colleague experts here to report a little bit back from what they see in their geographies, where, you know, that you saw kind of further on the right on this plotted chart before, because they're more advanced already in standardizing disclosure frameworks. So the first one is my colleague Guillaume Gauton, who is working in the French market for us. Guillaume, over to you.
Thank you, Max. Hi, everyone. So I would like to focus in the next 5 minutes on a country that has been particularly reactive regarding global climate targets and the adaptation and the transition to a low-carbon economy. and that's obviously France. I'm going to talk to you about the French Energy Transition Law. So this law is a broad framework that affects both corporates and investors. But here I would like to particularly focus on Article 173 that concerns institutional investors and is actually, for the moment, the most comprehensive framework encompassing climate-related metrics and ESG ratings. This framework regarding institutional investors includes various reporting options with a comply or explain logic for the first 2 years, so for 2017 and 2018, and then from 2018 onward, a mandatory logic. There are basically two main aspects when we talk about climate-related metrics in this reporting framework in France. First is the management of climate-related risk. So here the first step is to understand what type of climate-related risk is related to your investment portfolio. So the first step is a carbon footprint of the investment portfolio with a mention in the framework of scope 1 and 2 carbon footprint for investors. Looking at the other metrics that are mentioned in the framework, and Max already talked about these two aspects, you can find physical risk and transitional risk. When we talk about transitional risk, here the question the French government is asking to investors is, how do you manage this risk? And how do you set up objectives regarding the climate impact of your investment portfolio for the coming year? And the part of the legislation that deal with transitional risk is about the transition to a low carbon economy and how, as an investor, you contribute to this transition. So you first assess the risk you have as an investor regarding this transition, and then you explain how you actually would like to contribute and you want to contribute to the transition. This transition this contribution to the transition can be assessed through obviously several methodologies. The most used one for the moment is looking, for example, at the what is called the green-brown ratio, so the ratio of green services, activities, and products that a company is offering. But that's obviously a really dynamic landscape, and there are several other methods that can be applied by investors to demonstrate this contribution to the financing of the green economy. Two important facts here. We consider that already 25% of French asset managers and owners are already disclosing sustainability-related metrics that are online with the Article 173. And important to notice that this article will apply to institutional investors that have a total balance sheet of at least 500 million euros. Going to the next slide, it's for us really interesting to notice that there are already first movers and really important first movers in France when it comes to answering to the requirements of this legislation. So to obviously quote the most important here, it's ERAFP, Mirova, Amundi, and AXA that are all been reporting obviously in different ways and using different frameworks on the climate impact of their investment portfolio. Important to notice here that they have been taking into account different asset classes. And following these examples, we can already see that the key focus area of the French energy transition law for investor is first on reporting. So obviously it's a reporting framework, so every institutional investor will have to include sustainability criteria and targets in the investment policy. So you don't only have to report on your footprint, but how do you actually integrate climate-related metrics into your investment policy. The second important point is assessing, and that's what we've been seeing so far with this first mover, is that it's really up to the investor to estimate its contribution to the energy and ecological transition, as stated in the law. So each investor has actually a room for innovation and developing its own methodology for this assessment. And the really important fact to notice at the moment in France, and that's applying to this first mover, is that the government has created energy and ecology transition label for financial products. That means that each asset manager and asset owners in France can apply to the label, and the label is actually replicating and following the different criteria of the law. So that's a really interesting first exercise, because this label would be used by investor in order to set up best practices that at the end of the 2 years tasting phase would be widely adopted and made mandatory to all institutional investors in France. Last important point we wanted to notice is the media coverage. It's really interesting to see that the law is regarded as best practice at the moment, and has been covered in mainstream newspaper globally. So it's really up to French investors and asset managers having activities in France to be innovative here in order to propose new ways to assess their contribution to the green economy and how they adapt to this new reality being a low carbon economy. I will now hand over to my colleague Stephen Scott.
Hold on, Guillaume. The first questions are rolling in. So reminder to everyone, you can use different, obviously because we get them through different channels, different ways here on the panel to the right, the chat box or the question box, to send your questions. So here's a question: have financial institutions participated in the drafting of the transition law? So the question to you is, Guillaume, have there been investors involved in this drafting, or where in the law? Where is it coming from?
Thank you, Max. So actually, the working groups are still participating in providing recommendations and propositions to the government. So, for example, the Association of French Insurers and working groups also regarding assets owner in France have been involved from the very beginning. So also obviously the big French asset managers have been involved from the very beginning in drafting the many requirements and the many metrics that will have to be used in this framework. So it's really important to see that it's not a regulation that is coming from the government and imposed on the financial industry without consultation. The main actors, all the main actors and experts have been involved in the drafting of the framework, and they would actually still be involved for the next 2 years until the framework becomes mandatory.
Okay, very good. There's another comment here. It's not really a question. We are a U.S. asset manager managing assets for French asset owners and now have to comply with the law. So I guess probably as being asked by the asset owners. Is that something you see as well, Guillaume?
Exactly. So at Southport, that's a question we've had from several U.S. asset managers having activities in France. So it's important to see, and that Max, you introduced this fact at the beginning of the webinar, that the legislation and frameworks are emerging in a lot of different countries, and it's interesting to see that more and more asset managers around the world use the French framework as a first mover in order to frame a first climate-related risk framework for their investment strategies. And asset managers from the US, from Australia, from Asia are actually already setting up framework in order to comply with the French legislation, which is really interesting because this will, obviously in each geographical area you have different investment strategy. We can see that all the different investment strategy and different geographies would be covered by different risk frameworks when it comes to climate-related risk.
Mm-hmm. So if the regulator knew that their legislation actually has an impact outside their country, would probably make them proud. Okay, moving on. Thank you very much, Guillaume. We will have in the Q&A the chance to ask you more questions. Moving on to Stephen Schofield. Stephen, I hope we can hear you. You're dialing in from your phone. Covering the example of California. What's going on in California?
Hi, everybody. This is Stephen Schofield speaking from San Francisco. As many on this call would probably know, the state of California has been very proactive in implementing progressive policies and legislation that take action on climate change. This actually began in earnest back in 2006 under the leadership of then Governor Arnold Schwarzenegger, and has accelerated under the leadership of Governor Jerry Brown ever since. The California Air Resources Board has implemented and achieved a series of targets and goals focused on aggressively reducing the state's greenhouse gas emissions, mandating investments in renewable energy, and operating one of the world's largest emissions trading schemes. Within the financial sector, there have also been a few notable regulatory developments. The state's legislature has called on California's two largest public pension plans to divest from thermal coal holdings. And more recently, the California Insurance Commissioner has stepped forward and issued two new policy directives that apply to all insurance companies admitted to do business in the state of California. And California is the sixth largest insurance market in the world. The first policy is voluntary and calls for insurance companies to divest from all holdings in the global thermal coal industry. The second policy directive is mandatory and has asked insurance companies to identify and disclose on an annual basis their investments across the fossil fuel economy, with a specific focus on exposure to coal, natural gas, and oil. And both of these policies are grounded in the Commissioner's concern for managing the potential risk across the balance sheets of insurance companies over the medium and long term. For asset managers and investment consultants and institutional advisors who are working with insurance companies, perhaps these policy directives represent important opportunities to not only build portfolios according to these investment criteria, but also to help prepare your clients for these upcoming and ongoing disclosure requirements. And perhaps just generally speaking, to the extent that if you're working with insurance clients and you can get out in front of your clients on the issue of climate-related risks, perhaps you'd be best positioned to work with your clients in a more effective way. So that's the report from California for now. I'll turn it back over to Max, and we can keep going with the discussion.
Yeah, thanks, Stephen. Stay unmuted, please. So one question here is California the exception, or will there be more countries, more states following?
Well, it's interesting to note that there are two states in particular that are watching California quite closely. One being a very large state of in New York, and another the state of Washington. So they're essentially waiting to see how this all plays out. There is sort of a regional collection of states that are formally addressing climate risk for insurance companies, and many would suggest that the sort of on a national level, the NAIC, which is the regulatory industry body that oversees the insurance industry within the United States, will more formally adopt it moving forward. So for right now, all eyes are on California, but a couple large states are also paying close attention.
And Stephen, one question from my side. So how many companies or insurance companies are impacted by that, and what has been done so far? Is that visible already?
Sure. So in total, there are 1,300 insurance companies admitted to do business in California. Up until now, according to the Commissioner's office, the focus has been on insurance companies that have over $100 million in assets under management. I think in terms of compliance with this, it's fair to say that there's been a certain amount of not necessarily confusion, but not everybody has been so excited. So there's been sort of some back and forth. I think the first policy is a bit more explicit. The results of whether or not a company decides to comply with the state of California's request to divest from thermal coal holdings or to not comply, and the reason for doing so will eventually be made public. It's not quite clear exactly when that will happen. And in terms of the second policy, which is a very, very large data call, the state of California, as we speak, is processing that information. And I think it's for investors that are working with insurance clients, I think it'll be very interesting to see when they do come forth with the results of this very large data call. I think it'll be very instructive for this industry.
Okay, thank you very much, Stephen. So again, Stephen will be available for questions in the last quarter of this conference call. So if you have questions with regard to the California scheme or other developments in the US, please put them in the chat box, either directed to all or just to us, and we will read them out. So how can investors capitalize on climate change regulation? I mean, in a nutshell, if this transition is happening, and the signals are that there is the political will to do this, there will be losers and there will be winners, and obviously it is about avoiding the former and investing into the latter. And there are different ways and frames of doing this, but just to highlight a few aspects of this. So if you look at these NDCs, these nationally determined contributions, the best foot forward that the countries put out there, where they said we want to do our part in shifting the world to a 2-degree economy. These commitments come with all sorts of schemes, subsidies, driving of technologies and so on. And if you add them up, you see that it adds up to about $1 trillion a year, a little bit less than $1 trillion a year, that is funneled into this transition. And that is, of course, something that investors can participate in and invest into. A word of caution here, a warning. You see on the right-hand slide that actually the commitments as they stand right now from the NDCs are by no means enough to achieve the limit of 2 degrees. So if we're serious about this, this number should increase. So the numbers that you see here is over 13.5 trillion US dollars over the next 15 years. So that's a little bit less than $1 trillion each year. Did I say $1 trillion? I hope I said $1 trillion. If we look at the topic from different angles, this is from a study that just came out from BlackRock. So on the left-hand side, mind the gap, you see what type of spending is needed in the energy, the transport, the water sector, and what's currently projected. So you see this enormous gap that needs to be filled in order to fulfill the infrastructure spending. And again, this is these are areas to invest in. So this is very much on the opportunity side of things that we shouldn't lose sight of when we focus on the risks that come with climate change. And then finally, on the right-hand side, that's a example portfolio of that's kind of climate optimized from BlackRock. You see the index on top, and you see the portfolio in the middle, and then you see in the green line the relative outperformance. The message here is that that investing into climate performance can actually pay off for you. So how can you get started about this topic? Well, from our point of view, working with investors, Typically, investors talk about measurement initially, but from our point of view, that is step 2. We work along the value chain with them, and for us, it's we see that it's most rewarding for investors to first establish a framework, so to frame the topic of climate change, to build capacity internally, to think how the topic links to the investment process, and that is really different from investor to investor. So we've worked with quite a lot of investors that approach this entirely differently, but it needs to map with the DNA. And after the framing comes the measurement, which is important, and we see certainly currently trends of a deepening of the measurements as well as a widening. I'll talk to that in a second. And then based on this measurement, there is the momentum of acting. So what are we doing about the knowledge that we've acquired? We show this in a different way on this chart here, where you see to the left-hand side the understanding, and then to the right-hand side the acting, and this kind of learning curve that investors typically go through. The first step in understanding climate impact is typically to run a carbon footprint. It's kind of a status quo analysis. Where do we stand? Because if we believe that we need to bring down or want to bring down the global greenhouse gas emissions, we need to bring down the emissions in our portfolio. So we need to measure that over time, and the carbon footprint is one way of doing this. It's followed then typically by deeper analysis, and then once a full understanding exists, by acting, for example, with new or let's say tailored investment strategies. To measure an investment carbon footprint has become super simple and super cheap as well. It's not expensive anymore. There are online footprinting tools where you can upload your portfolio and download a carbon footprinting report. So two of the leading tools are based on our data. One is called Your SRI, that is really geared towards create investment carbon footprints. The other one is called Clean Capitalist, that is more a tool to backtest how your performance would have been if you would have divested or changed your climate strategy a few years ago. So it allows for backtesting, so it's more portfolio construction if you want. And what you get out of a carbon footprint is, but it's only part of the picture. And great in the sense that it allows you to get a first understanding of your current greenhouse gas exposure. So you understand your emission exposure at a certain point in time. It serves as a heat map and a starting point so that you understand what you can focus on. And aside from telling you emissions, it also tells you about sectors, attribution analysis, about the transparency of the companies, and so on. And it's a great way to go back to your portfolio once in a while and see if your decarbonization strategy plays out, because if you run a decarbonization strategy, your carbon footprint should go down. That is over time. So over time, you should see a downward trend. The carbon footprint is, from our point of view, not a good way to manage a portfolio. It's this once in a while, or starting point, and then once in a while control, this check, because it's only part of the dimensions of climate change. You see that here on this chart in front of you. The carbon footprint is on the bottom right. We call that current consumption, so it's current greenhouse gas exposure. A carbon footprint tells you if you own part of a company, you own part of the greenhouse gas emissions, you know where you stand. What it doesn't tell you is in how far you invested in future emissions that come from fossil fuel companies, reserve-owning companies. That's on the left-hand side. We call that future production. Here we work with our friends from fossil-free indexes. And there you understand in future tons of CO2 what the emissions are. And then the third dimension that I would like to highlight here is the two parts that we look at current exposure, not at the trends. So the third part is, how are companies positioned towards the risks and opportunities of climate change, and how do they embrace climate change? So something that is not pointed but forward-looking. I'm informed that there's a question. Let me see. Maybe one of my colleagues can read it out to me because I'm in a different view.
Hi, Max. I'm going to read the question. The question is coming from Kevin Fox. How is a thermal coal holding defined? What % of a company's sales generated in this field?
Yeah, so this is an interesting question. So I think it goes, if I understand correctly, to the approach that more and more investors divest from thermal coal, and so you have large insurance companies doing that. You have pension plans doing that, especially in the foundation space, the divest-invest movement. They divest from fossil fuels, and what they typically do is they divest from thermal coal, and they do that based on revenue from thermal coal. So that is one way of doing this. You basically say this company derives more than 30% of revenue from thermal coal, so we exclude it. So that and that would be then the answer to your question, how that is defined. So that would be one way to define that. However, we are struggling a little bit with this approach alone. I think we applaud investors who take the step, but because it's certainly, from a risk perspective, one way of dealing with the decline of the coal industry. However, if you look at it from an impact perspective, there are quite a few companies that derive very little revenue from coal, but actually are large coal producers. So if you look at Glencore, for example, this is based on research from our friends from Ökom Research, they are the second largest coal producer in the world. However, it's, don't quote me on the number, but it's only 5% of their revenue that derives from coal. So if you have this 30% threshold, you might still invest in Glencore, the largest coal company out there.
I'll just quickly add to that, Max, if I could. The state of California is following the following definition for thermal coal, and that would be extractive companies that are, as Max said, generating 30% more of their revenue from thermal coal extraction, but also the utility sector, where you can identify utilities that are generating 30% or more of their power generation from thermal coal, and then lastly, other industry sectors that are deriving 30% of their revenue in the supply of services or technologies or more broader solutions to the thermal coal industry.
Thank you very much, Stephen. And just to add to the point that I made before, one way to overcome this challenge of revenue and not capturing Glencore, if that's your desire, would be to look at a different metric, which is percentage of global production. So you can basically combine these two metrics in order to define your divestment strategy, as one example. Well, back to the presentation. So I was talking about the top of this this pyramid here, which is looking at trends of companies. So a carbon footprint and reserve analysis doesn't tell you if a company is about to reduce or increase their greenhouse gas emissions, and if they're dealing well with risks and opportunities. And so there is now great work done with our colleagues from Ökom Research. We do this together with them. You see an example here where we basically not only look at greenhouse gas emissions, but we actually look based on 100 different parameters whether a company is a climate laggard, an underperformer, a performer, or a climate leader, which has nothing to do or very little to do with current greenhouse gas exposure, but with cross-sectorial and sector-specific aspects. Cross-sectorial would be, does the company have a climate strategy? Is it on track to achieve that? Sector-specific would be, in its specific industry, is this company actually in a transformation process or not? So we talked about deepening. Now, one word about widening. If you look at this graph, you see that we are currently doing these type of climate impact assessments for all sorts of asset classes. However, the one asset class that is standardized and easy is stocks. Therefore, you see it on the bottom right of the graph. That's basically plotting standardization against complexity of analysis. So stocks, screening equity portfolios is not super complex anymore. It's relatively standardized. Corporate bonds are getting there. That's why you have this downward facing arrow. With other asset classes, that's not so much the case yet. So while you have these online screeners for the bottom right, if you want, everything that's further up to the left requires specialist knowledge and bespoke screenings. because there is no standardization. It's partly relatively complex to do this type of assessments. Moving on to the acting part and therefore to the final part of the presentation. So now that investors understand where the risks and the opportunities lie in their portfolio, which are driven through this transition risk, which again is driven, in turn is driven by legislation, by regulation, there are of course certain ways of adjusting investment strategies. So what we're plotting on here are basically different types of approaches that we either can see out there or that we can already or that we can see in development. So strategies, and those can be active or passive strategies, include fossil-free investment strategies. So basically you invest in your specific universe, but you don't invest any longer in companies that have fossil reserves. You might have low carbon strategies. So these are strategies that are optimized based on a carbon footprint. So we basically say we invest in those companies then within an industry group that can produce their products at less greenhouse gas emissions than their peers, because that basically increases the chance that they will be still operational in a 2-degree economy or in the shift towards a 2-degree economy. Climate leader strategies are really investment strategies that focus on companies that embrace the topic of climate change, that have strategies in place that prove that they are in a certain transition. And you can then qualify this more by looking into companies that have specific climate targets that you can then aggregate also in a portfolio level. So companies that say we will reduce our greenhouse gas emissions by 10% until 2030, or unit of output by 10% or so. And then finally, there's more and more discussion about investing in companies that are 2-degree compliant. There are two different approaches out there. One is called science-based targets, where you have now, I think it's 160 companies that commit to become 2-degree compliant. Another one is by the 2-degree investment initiative that looks at the capex of companies in certain sectors and how they are currently, based on their plans, in a transformation. We work with all of them. You can see these type of logics reflected already in some indices, and stocks, for example, has developed an index family that follows this value chain, and is really one of the deepest out there. While this was more for mainstream investors, another area of investment is, of course, direct investments into the 2-degree economy, meaning financing or investing into the energy transition. We put a picture on here of I think it's a hydropower plant in Indonesia, if I'm not mistaken. The geography that needs these investments the most and has also the biggest opportunity in terms of climate impact, but is of course risky from an investment perspective, is the emerging markets. So we have a little bit of experience in that by mapping, in this case, high net worth individuals to projects on the ground. So this goes more into the area of impact investing. It's certainly a space to watch. And with this, I would like to move over to the Q&A and finish on 3 thoughts. The first one is, we do see that this topic of climate change is no longer part of, or only part of, the ESG discussion. It is a topic on its own now. It's decoupled, and it's taking on its own life. You have a lot of investors looking into it that are not yet there when it comes to broader ESG, but they are realizing that climate change is material. Second thought is that regulators, or observation is that regulators are closing in on investors. There are more self-governing initiatives by investors, so we will see much more transparency on investment climate impact. And thirdly, this is really the time where investment strategies are popping up left and right that help investors to decarbonize their portfolio and to basically seize the risks, or avoid the risks and seize the opportunities that come with this transition. All right, with this, I would like to turn to questions. Again, please use the chat box, either the one for questions or the chat box that goes straight to us. Here's one for Stephen. Stephen, well, if I paraphrase, I think it's on what impact will have the election outcomes on the topic of climate change and investments?
Well, it's a very interesting situation. Climate change, I think, for the first time in American presidential election history, has landed itself on the official platform as a political issue. And it's interesting to note that one party, the Republican Party, has aligned itself with the fossil fuel industry and has taken sort of a bold stance, somewhat in opposition to taking action on climate change. And the other party has led with climate change as a potential wedge issue. So for investors and business leaders moving forward, looking ahead to the upcoming election, obviously there will be a winner and there will be a loser. And I think in the first case, if the Republican Party were to win, it's fair to say that this would result in a significant amount of loss of momentum, particularly with respect to the Obama administration's Clean Power Plant and some of the other executive order strategies. And conversely, if the Democratic candidate Hillary Clinton wins, I think it's fair to say that there will be a great deal of forward-looking momentum. It has been reported in a couple different circles that there is a growing faction within the Republican Party that has come to the table, and there's been a growing discussion within the United States that putting a national price on carbon would be in order. So depending on the outcome of the presidential election, perhaps 2017 could feature some significant discussion about establishing a national carbon tax, which, of course, for the American political landscape would be a pretty large step forward. So obviously, lot to stay tuned for there.
What side are you putting your money on? Well, you don't have to say it on the webinar, I guess.
Yes, it would not be appropriate. But okay, for those that follow New York Times and Nate Silver's, I think right now the strong odds are that the climate change supporting the party that is embracing climate change as a political issue has greater chances of winning the election as we speak right now.
Okay, thank you very much. So there's a question for well, I guess both of you. How can we finance a low carbon economy and maintain a large investment universe? Guillaume, do you want to take this?
Yes. I mean, that's obviously a concern that every ESG analyst has nowadays, because as you add more filters to your investment strategy, obviously you will exclude sometimes entire sectors of your investment universe. But let's face it, it's a new reality. The low carbon economy is emerging and has, as Stephen said earlier, there would be winners and losers, and it's already pretty clear that sectors will stop receiving this huge amounts of subsidies they have been receiving for decades, and as an investor you can't ignore that. So the entire economy is shifting to new technologies, new services, new products in general, and that's a cross-sector phenomena. So you will actually be maybe reducing in terms of a number of companies in the short term your investment universe, but on the long run you would be discovering new companies that are the one proposing the services that will be necessary for low carbon economy.
Okay, thank you very much. So we are at the end of the webinar. If you have additional questions or comments, please feel free to email them to us. I was asked to highlight 2 more webinars to you next Tuesday, run by South Pole Group. One is focused on the Asia, it's very early in the morning for you, for probably most of you, or the middle of the night, on the Asia Pacific region. We do that together with CARE and with the Asian Institutional Investors Group on Climate Change. And it is focused on kind of low carbon investment solutions. The second webinar is in the afternoon European time and on sustainable development goals and how investors can deal with that. So if you haven't received an invite, please let us know and we can sign you up for this. Those of you who participated, you will, in this webinar, you will receive the slides, the recording, and a fact sheet dealing Article 173. So let me thank my two colleagues, Guillaume Gauton and Stephen Schofield, for their help, my colleague Fatou Samate for setting up the webinar, and all of you for participating and for listening. Have a great rest of the day. Thanks, everyone.